Well, Wall Street turning higher ahead of the market open this morning. Consumer inflation figures for the latest month mostly in line with estimates. And this does come on the heels of the mixed December jobs report. In 2025, employment growth slowed while the unemployment rate ended the year at 4.4%, but remained fairly low by historical standards. Well, joining me ahead of the market open on this Tuesday morning is Ed Siddell, President and CIO at EGSI Financial. Good morning, Ed. Thank you so much for joining me. We finally got the final CPI reading for 2025. And right now we are looking at expectations of the Fed staying on hold at its January meeting. So what are your key takeaways, not just from the inflation figures, but also the non-farm payrolls and the unemployment rate we got last Friday?
Honestly, I think it's predictable. We're heading in the right direction. If we look at the revised GDP, the economy is growing. There are estimates for the fourth quarter of being higher than the third quarter, so we're headed in the right direction. The big thing for us, really, what we're looking at is we need to make sure that even as the economy grows, that it's not excessive too quickly. So we need to make sure that it grows at the right pace, because really what we don't want to have happen is inflation to get out of control, especially if we try to lower rates at the same time. So as far as the economy goes and the markets, we're very optimistic, but we're very cautious depending on what the Feds do.
Yeah, and building on what you just said, Ed, on the heels of the December jobs report as well as today's CPI data and ahead of tomorrow's producer prices, what is your outlook for monetary policy for the central bank in 2026?
When we look at really the 12-month swaps as compared to the overnight federal funds rate, going all the way back to 2023, really what it shows is that the Feds are really behind the eight ball. They're slow to the game, as they were at the inverse on the 12-month swap, showing that inflation was really raging. Yeah, and they were saying that it's transitory. Now, when we look at it, they're slow to the game, and they really should have been lowering rates a little bit quicker than they are right now. But now it may be a little bit too late. So we really have to look at lowering rates. What's that going to do from an inflationary standpoint? It's estimated that inflation last year is about 2.7%. Really, the focus that we're looking at are nominal wages. Are they really increasing above the inflationary rate? So last year, again, it's estimated that nominal wages grew about 1.5% above the inflation rate. And so as long as we can keep pace above inflation, I think we're okay. And we may not have to lower rates as much as what everyone's anticipating.
And speaking of which, robust consumer spending drove stronger than expected economic growth in Q3 of last year, which was the fastest pace in 2 years. But there are signs of strain, with inflation-adjusted disposable income flat, suggesting many Americans are struggling to keep up with rising prices. So with anticipation of stimulus this year, give us your expectations when it comes to growth.
I think once people start getting refunds back, that is going to provide an awful lot of relief. The other thing that we're looking at, the big beautiful bill, the impact that that's going to have on paychecks starting this year, as people are already starting to receive them. They're going to start receiving, whether it's monthly or biweekly or bi-monthly, over the next week or two. That's going to start having a positive impact. We're really not going to start feeling that probably until February, March, and April. And I think that that's really going to be one of the big drivers going forward. Some of the other things that we're looking at, the current administration's proposal of capping interest rates on credit cards of 10%. That's really good for those that have credit right now, because it's going to provide more disposable income at the end of the month. But again, it's a double-edged sword, because the consequence to that is these banks, they could restrict credit going forward and really hamper the growth of the economy. So those are the things that we're looking at going forward. But again, overall, we're very optimistic on both the economy and the markets.
Yeah, and Ed, we have about 60 seconds here before the market opens. So when it comes to some of the headlines that are coming out from the nation's capital, in particular to credit card interest rates, how do you think all of this will actually shake out?
Again, just like tariffs, I think it's more of a tactic than anything else. Because really, when you look at it, A lot of these credit cards, they're now charging upwards of 30%, and that's almost usury. So if credit card companies actually start to lower these rates on their own, and we don't have to have an executive order to lower those rates, I think that's going to be beneficial to everyone. My fear is, again, if we do have an executive order to cap those at 10%, that knife is going to cut both ways.
Well, Ed, always great talking to you. Thank you so much for joining me, and thank you so much for sharing your perspective today.
Absolutely. Thank you for having me.